Hi everyone, good afternoon. Thank you so much for joining us today on behalf of the South African Chamber of Commerce in Singapore. I'd just like to welcome you all and thank you for your time. It has just touched 5:05 here in Singapore this afternoon, and we are joined by Marisca, who's in South Africa, so it's still early morning for her. But our topic for today's discussion is ceasing South African tax residency, and what Marisca and I have done as members of the Chamber is we've compiled a how-to guide for individuals living in Singapore to understand, how do you do this? What are the implications of doing this, and kind of what are the benefits of doing this? So without further ado, I'm going to get into the introductions. So Marisca is a member of the Chamber, but she's also a director of Mint Accounting, and she is a tax advisor qualified in South Africa. Marisca and I have been working together for almost 2 years now, and we've been discussing the topic of immigration and non-resident tax. So it is absolutely a pleasure to have you here with us today, Marisca. So in terms of myself, my name is Michael, and I am on the board of the South African Chamber of Commerce here in Singapore. I've been in Singapore for just over 3 years, and I am also an associate partner of the Heritage Partnership here in Singapore. So that is a partner practice of St. James's Place, and what we specialize in doing is we specialize in financial planning, offshore financial planning, and my speciality is working with South Africans specifically. So without further ado, Marisca, I can see that you're still muted. Sorry, let me unmute you. Give me a second.
Thank you, Michael.
You have a voice, sorry.
I have a voice now, thank you. Hi everyone, it's nice to be with you today.
So Marisca, I think an important place for us to start is simply the main reason we put this guide together is why is ceasing South African tax residence important once you have left South Africa and if you work in abroad?
Yes, Michael. So as per the Section 22 of the Tax Administration Act, SARS actually requires people to inform them in any change of your registered particulars. And this includes your physical address, and it also includes your resident status. So immigrating from South Africa does not automatically make you a non-resident of South Africa, which is what a lot of people do believe. They believe that when they leave, they just become non-residents. But really what it means is you're just a tax resident living temporarily abroad. And the reason why this is important to get it right is because the gross income definition of the Income Tax Act stipulates that South African taxpayers pay tax on their worldwide earnings and also capital gains tax on their worldwide assets, which could become very costly in South Africa. Versus if you're a non-resident taxpayer, you only pay tax on your South African source-based income. So that does make a big change.
Absolutely. So again, the reason this is so important is to not pay your hard-earned income unnecessarily to the taxman in South Africa, just simply because you didn't follow the process.
Exactly, yes. So foreign income in South Africa used to be tax-free, obviously, if you met the requirements. And as of the 1st of March 2020, that changed where SARS has just put a limit on it. So if you meet the requirements of the foreign employment income exemption in terms of Section 10, then your first 1.25 million rand will be tax-free, and the excess of that will be taxable in South Africa. Now, SARS has entered into double tax agreements with most other countries, and that just allows for relief on double taxes because you shouldn't pay double tax. Now, one relief like this is the Section 6 Quat relief, which is basically just a tax credit between the countries. So if you earn above the 1.25 million rand, then that X is taxable in South Africa. But if you earn the tax or paid tax on that income also in the foreign country, that tax paid is a credit in South Africa. So it now just depends on which country are you in and what tax rate you are paying tax at. And we all know that Singapore enjoys a very low tax rate versus what we pay in South Africa. So you could actually end up paying quite a large amount of tax in South Africa living in Singapore, which you don't want to do.
Absolutely not.
Yeah, so the requirements of the Section 10102 is that you must be in an employment contract. You can't be an independent contractor or a subcontractor, and that's very important. It's actually something that we send to SARS when they do the audit on this exemption. We have to send them your employment contract, so that's very important. And then also you need to spend at least 183 days out of South Africa, of which 60 of those days needs to be consecutive, and it can be in any 12-month period as long as it starts or ends in your tax year, but that gets very technical. So just know that 183 days and 60 must be consecutive. Then you do get that 1.25 million rand tax-free. So
essentially, if I was living in Singapore and I was at the highest income tax bracket here, which is 22%, I would also easily be in the highest tax bracket in South Africa. And basically, I could be on the hook for the difference between the 45% in South Africa and the 22% in Singapore, less the exemption, which is still a substantial amount of money.
It is, especially if you're not living in South Africa, you're not enjoying any of our beauty. So why would you be paying those taxes?
Absolutely. So I think moving on to the next bit then, it's really talking more about double tax agreements and tax treaties. Could you tell us, basically, is there a difference between a tax treaty and a double tax agreement? What is the difference and how do they work together?
Yeah, so they do work together. It's right that you call it like that. So the double tax agreement is the agreement that two countries will enter into with each other. And basically the format is the same. It's just obviously certain taxes are covered and certain people are covered. So the double tax agreement gives one country the sole right to tax the income. So that's basically what the double tax agreement does. The tax treaty is a document that we look at that stipulates how do you become an exclusive tax resident of that country. And it's that country's specific rules, and all countries have different rules because obviously they have their different tests. So obviously Singapore, we have the test here, and to become an exclusive tax resident in Singapore, we do look at the quantitative and the qualitative test. And the individual needs to be physically present in Singapore for at least 183 days in the calendar year preceding the year of assessment. And they must exercise an employment in Singapore for at least 183 days of the year. And then also they must reside in Singapore, and their absence from Singapore should be temporary and reasonable. So that means like you can go on holiday, but you can't come back to South Africa and live here for a little bit. Then you don't meet that requirement.
Okay, absolutely. So now once we've satisfied those qualitative and quantitative tests and we're deemed to be an exclusive resident of the one area, be it Singapore, at that point, that's when double tax agreements between, for example, Singapore and South Africa become applicable.
Correct, yes. So then we look at all the tests, and we could then determine if you're going to be an exclusive tax resident of Singapore or South Africa. So the Article 4 of the double tax agreement mostly is the same in all of the double tax agreements. And basically what it looks at is it provides a tiebreaker. So if there's uncertainty of where you are going to be an exclusive tax resident, we look at the tiebreaker clause, and that's basically where we determine who gets the right to tax.
Okay, understood. And for everyone who's listening, one of the things you can do if you have paid taxes in Singapore already is you can write to IRS here, who's the tax authority, and request a certificate of residence. And basically this is a certificate of tax residence in Singapore. And what this does is it shows that you've paid taxes in Singapore and you are residents in Singapore for tax purposes, right? So that helps with the double tax agreements as well. Now, in order to get that, it's really simple. You log onto your IRS portal where you submit your taxes, and you request what is called a COR. In Singapore, they love their acronyms. It just stands for Certificate of Residence. Another thing you can do is you can simply Google IRAS, I-R-A-S, and Certificate of Residence, and you will see the first thing that pops up is a page where they discuss how you get it and who is able to get it. And there's also a Excel spreadsheet you can download from the IRAS website to complete this and email it to them. And thereafter, they will post you a physical copy of your certificate of residence. I got mine last year. It's just a letter saying that you were here, you paid taxes, and someone signed it. But that is invaluable should you have some tax consequences in South Africa in the future, possibly.
Michael, that's also a very important document that we use in the process of seizing your residency in South Africa. Like to SARS, that's a very important document. They want to see that because to them, this is confirmation that you are paying tax in another country. And that's how they then allow you to become a non-resident of South Africa.
Again, so I can't stress the importance of this simple little document that's just a few clicks away. But in terms of just like a quick sum up of what we've just run through here and why ceasing to be a resident is so important, it's just South Africans pay income tax on their worldwide earnings. And this means that if you haven't immigrated, if you've immigrated without informing SARS, you must declare your foreign earnings to SARS. And this means that you might be liable for tax on this income. But also, you're risking a possible capital gains tax being payable on your worldwide assets, not just your South African-based assets. And then also you have to declare your worldwide earnings because you're obligated to in accordance with the Tax Administration Act. So that's 3 bullet points summing up what we've been through here. And I can already see that we're getting messages in the chat here, which is very good. Thank you so much, Ryan. We will have a Q&A towards the end of the session, so please do feel free to pop all your questions in the chat. There's nothing too simple, there's nothing too complicated. If we can answer it on the call, we'll do so. And if we can't, Marisca and I will be able to follow up with you separately after the session today. So moving on, obviously we all know this became a big topic of conversation from March 2020 when they made the changes to the foreign employment income exemption. But since then, further conversations have come around, and Marisca and I spoke towards the end of 2020 about the phasing out of financial immigration. That has now come into play as of March last year, 2021. So Marisca, could you walk us through what has changed with, the phasing out of financial immigration?
Yes, Michael. So the biggest one is that financial immigration used to be a South African Reserve Bank process, really, and they drove the process. They needed a tax clearance certificate from SARS, but really the process was a Reserve Bank process. So we had to report to the Reserve Bank and get an immigration tax clearance certificate from SARS. And then you could immediately withdraw your retirement annuity when you've done that financial immigration. So just leave, do this application, take your retirement annuity fund out of the country. And then you had to close all your South African bank accounts and you could only have a blocked account open. And then if you had no South African assets or income remaining, you could deregister your tax number. So some of those are still the same, but what has now changed is that we don't report to the Reserve Bank anymore. It's a SARS process. And what we do is we apply through SARS to change your tax residency status in various ways, which we will cover a bit later. And the biggest change is also that the retirement annuities can't be withdrawn anymore immediately. You have to be a non-resident for 3 consecutive years before you can actually withdraw that. Now, an important factor and a question that actually comes up a lot is, does that 3 years start on the 1st of March 2021? And the answer is no. It's basically 3 years, however, whenever that started. So if you've been out of the country for 10 years, you already qualify. If you left in 2020, then maybe you have another 2 years left or another year left. So it's just that you have to have been 3 years non-resident. And then also you do have to inform your bank now that you are a non-resident, and they are quite strict with this. They have like the speaker that they send you, and they want to have your tax number of all jurisdictions where you are registered for tax. So it's important to inform them about that. And then also you do need to close all your bank accounts, and you can only have a non-resident bank account, and it doesn't have transactional access like your normal traditional bank accounts do. So unfortunately you don't have that access. And then another big one that fell away was that all of us South African tax residents, we can send up to 1 million rand a year out of the country without asking anyone's permission. We don't need SARB or SARS to ask them. We can just send this money out. But as a non-resident, you can't do that anymore. That falls away, and any money that you want to send abroad, you have to apply for a foreign investment tax clearance certificate, and then only you can send money abroad. And you can apply for up to 10 million rand, or you can do a special approval from SARS and SARB up to 20 million rand.
But that is a very big thing that has changed, because before this, you didn't have to ask permission. If, you know, a husband and wife wanted to move 2 million rand out of the country, they could do 1 million and 1 million in their own right. But now that's changed. And that is a biggie when you're moving your life savings abroad.
Correct, yes.
So we're getting some really good questions in here, so please do keep them coming. And from what I can see, we are going to answer these from some of the content we have prepared already. But essentially, the methods and the process for ceasing residency now, I mean, has that changed since the changes that you've just mentioned?
So not really. I mean, we all know that SARS has always been, or SARB has always been the one where you do your financial immigration, but really giving up your tax status with SARS, that has been the same, or is the same process, but you have to, the thing that has changed is ticking your box on the IT-12, where before, I think it only opened in 2017, and you could only complete your immigration date if you had immigrated in that year. But SARS has changed that now from last year, where they ask you if you have immigrated in any prior tax year, you need to declare that. And then you also, on your tax return, the capital gains tax section will open, where you then need to declare if you had any capital gains to declare to SARS on any of your worldwide assets when you left the country. So that process has changed slightly. And also another process that has changed is SARS has created a template now where it's a formal declaration that you've ceased to be a resident. And once you have submitted that, SARS will issue you with a notice of non-resident status. So it's also a nice document for you to have as confirmation that you have done this. And prior to this, SARS has never issued that document. So it's really, I'm very happy that SARS has opened that for us. There's obviously a lot of supporting documents that need to go with that, and it's like your tax residency certificate, the document that we just spoke about earlier. They want your proof of address to show that you really do live in that country. And then what they have recently added to the list is they want a copy of the visa that you had when you went to that country. So what kind of visa? Obviously, they don't want to see a tourist visa. That doesn't give them a lot of, they're not happy with that. And then also they, if you have permanent residency and taken that up in the other country, they do want a proof of that. And then also depending on if they're not happy yet, up until that case, they do ask additional information like what property do you have in South Africa and what are you doing with it and where's your family. And that all actually goes back to the tiebreaker of Article 4, where, you know, where's your permanent home and your habitual abode and your central of vital interest. So they just want to kind of check that you've met all those requirements. And that's what the apply for Cease to be resident is all about. And then also, if you have funds that you want to send out of the country at the time of immigrating, we then apply for an immigration tax clearance certificate, and this then allows you to take that funds out of the country. So that would be if you have sold your house, or maybe you did qualify to withdraw your retirement annuity, you then need to apply for the immigration tax clearance certificate. And then everything that you've listed and you've proved that you have that fund, so you show your source of funds, then you can send that funds out of the country. And then lastly, is that if you then at that stage have nothing left in South Africa, no income, no assets, you're not going to have future distributions from a trust or something, then you deregister your tax number because you can just end your ties with South Africa. There's no need to keep that then if you've got nothing.
Look, I think that was a very concise summary of what we've put together here. And everyone, you will be getting a copy of this guide that Marisca and I have put together after the fact, and you'll be able to read through this in detail and understand it. But what it really comes down to is if you are ceasing residence, right? What we've put here is basically you might have to provide some specific supporting documents, as Marisca mentioned. So being able to have a body of evidence to support that you are non-resident is extremely important. And this is, there's nothing too big or too small to help prove that you have vital interests or your sense of vital interests outside of South Africa, because obviously if it can be proved that they do not, and you fail the tiebreaker clause on a double tax agreement, that means SARS can tax you. So it's extremely important, that the body of evidence is pretty good. So please, yeah, keep track of that, is all I'm saying. So like we went through, so this is the process of what you should do in order to cease residence. But you go through all of this, you cease to be resident, and then what happens? What are the consequences?
Yeah, so the biggest consequence is the exit taxes, as it is called, and it's Section 9H of the Income Tax Act, and it's basically capital gains tax on your worldwide assets. And capital gains tax is triggered on the date that you cease to be a resident. So it's important to note that this backdates to when you actually left South Africa and not now. If you are doing your cease to be resident 5 years after you've emigrated, it's not the assets that you own at this date. It's when you cease to be a resident. So it's not necessary that you had to sell your assets. The proceeds of your assets would be the market value of the assets at the date of ceasing to be a resident. So whatever that market value is, you'll then use that to determine your capital gains tax. And what's important to note is that if you had capital gains tax, let's say you left 5 years ago and you had actually something to declare and you did not, then we apply for a voluntary disclosure program. And this is just to avoid underestimation penalties, because those can be quite harsh. SARS can give you a penalty of up to 200% if you did not declare that. So what we then do is apply for the voluntary disclosure. We just say, listen, the client wasn't aware of this, because most people are not aware of the fact that they had to do this. And mostly, well, in all my cases, it's been accepted. So then you would pay your capital gains tax, and then you would also, unfortunately, have to pay the interest on the money that you owed SARS in that period, but you do get the underestimation penalties waived in that case. And the property or your assets that will be included in your deemed capital gains tax that triggers when you become a non-resident is all your worldwide assets. And then certain things that's excluded from that is if you have immovable property in South Africa. And that's just because you non-residents and residents of South Africa pay the same capital gains tax on property. So you'll pay that in the future when you actually sell it. And then also if you have shares in a permanent establishment in South Africa. So this would be if you have at least 20% shares in, let's say, a business or a trust or any entity in South Africa, and that entity then owns at least 80%, their market value must be at least 80% consist of fixed property of South Africa. That would then be excluded on your exit tax calculation, because once again, you'll pay that in the future when you actually sell this. And then also certain equity instruments, so equity shares with your employer, because if it hasn't vested yet, then obviously you can't pay capital gains tax. So that's excluded. But mostly where you pay capital gains tax on your exit is if you own shares. And it would be, you'll pay the capital gains tax on the market value. You can keep the shares in South Africa or wherever your shares are, but in the future, when you sell those shares, you're not going to pay capital gains tax in South Africa again, because non-residents do not pay capital gains tax on shares in South Africa. So it's literally just when you cease to be a resident, and then you can keep it or you can sell it, however you choose to do with that. And then one thing that's usually not really nice to pay capital gains tax on is if you have foreign property. And that unfortunately does trigger when you cease to be a resident. So it's also just important to do a calculation, see where you are with that, and then do a voluntary disclosure if necessary.
So again, being able to do the voluntary disclosure program is also going to protect if you've left the country for a while and then you only ceasing residence. But since the period where you did cease residence, say in 2015 or 2018, your assets have grown substantially between now and then. Being able to apply for the voluntary disclosure program can potentially protect you against the difference in those gains between 2018 and today, for example.
Correct, yes, because you should not be paying capital gains tax then on the assets that you acquired after leaving South Africa and after meeting the requirements of the tax treaty of the other country. So it can become quite technical, because if you do still come back to South Africa, it could be that you only become a tax resident or non-resident at a later stage. So, but mostly it is in the case when you emigrated from South Africa.
Right, so again, very important to have your house in order if you leave in the country for good or for a sustained period of time before returning, because if you don't, this could become quite a big problem.
Yes, Michael, I think that we should probably also just touch on the subject of it was quite a big topic last year of exit tax on retirement annuities. And
yes,
this was going to be that on the date that you cease to be a resident, whatever the value of your retirement annuity at that stage was, SARS would have levied a deemed withdrawal on your fund, and then you would have had that your withdrawal tax payable, and you wouldn't have paid it at that stage. You would have paid it in the future when you withdraw it, but they would have already at that stage deemed it. But Treasury met on that last year again, and the bill was not passed. So just to let everyone know that your retirement annuity funds is still safe at this moment. They are obviously always planning and working on how they can get that to work, but at this stage it wasn't passed, so it's still safe.
Thank goodness for that. And everyone, there was a lot of fear mongering in the press about this last year when they were having these discussions. And to break it down very simply, if you leave the country and you're eligible to withdraw your retirement annuities, at that point, once you've left, you ceased residence, a deemed disposal happens, which means essentially, even if you haven't taken the money out, SARS says that from this date it's been deemed, but you will only have to pay the tax once you've actually done the withdrawal. So this is, as Marisca said, something they've been speaking about, but have not yet been able to pass in Parliament and in Treasury. So watch the space on that. So I think that brings us swiftly along onto the topic of retirement annuity withdrawal on immigration and maturity. And this is something that I work very closely with my clients on here in Singapore, is helping them to understand, whether it makes sense for them to take the hit on the taxes upfront now versus if they are in a position where they should wait to receive the proceeds of their retirement annuity at maturity. Now, some of the things we think about when we talk about this is simply, what age are you now versus age 55? Or your planned retirement on your RA, and how long is that? Is it 5 years, 10 years? And also understanding, where are your future movements from here, and would you like to have your assets in a currency that is not denominated in rands? Do you want to have it in a low tax environment like Singapore? And is there enough time that if you take the hit and you invest it offshore in Singapore in a low tax environment in a strong currency, that your investment can actually catch up with the loss that you've made? So this is extremely important in your decision of whether you should pull your funds from South Africa or not. And Marisca, could you talk us through the difference in the actual withdrawal on immigration and the withdrawal on maturity?
Yeah, so if you withdraw on maturity, which is at the age of 55, you get the first 500,000 tax-free, which is taxed at a 0%, and then the balance is then taxed at 18 to 36% in those brackets that we have there. So if you, at the age of 55, if your retirement annuity value is below 247,500, you can withdraw the full lump sum, and that's going to be tax-free. So you have everything out. But if the value exceeds that, then you can only withdraw 1/3 lump sum, and then the 2/3 need to be invested into a living annuity in South Africa. And that living annuity would attract normal tax payable in South Africa, and you need to submit your annual returns here in South Africa as well. Now, most other countries also want to tax that living annuity or your pension income. And again, to avoid double taxation, you could apply for a tax directive from SARS to ask them to levy a 0%, but you have to prove to SARS then that you've actually paid the tax on that pension in another country. So I think this comes down to also, it ties in with the fact that they have to consider how much they will lose by keeping it in South Africa from an investment point of view. But also another factor that they must consider is the tax burden, really, or the administrative burden of having a living annuity in South Africa when that's all you earn. You don't have anything else here. You have to do the tax returns and you have to apply for the annual tax directive from SARS and possibly pay income tax here as well. So it's just something to consider if you are still at a younger age and you do have time to make up for that. So on the next slide, we have the immigration rules, and that is that, and you can see it's quite a big difference, is that only the first 25,000 is taxed at 0%, and then the balance is taxed at 18 to 36%. So it's quite a higher tax that you pay, but the benefit is that you can withdraw your full lump sum. So there's no living annuity left in South Africa. It's the full and final tax that you pay on your retirement annuity, and your ties are cut from with South Africa in terms of your retirement annuity.
Yeah, so again, it's having the conversation of, like, how much longer do you have to go? And are you willing to have 2/3 of your life savings in South Africa put into a living annuity that you can't withdraw, and they can only pay you up to 17.5% of that per year? And that 17.5%, which is the maximum that you can draw from those, would then be taxed by SARS. And if it's not by SARS, it'll be taxed probably by whichever jurisdiction you're enjoying your retirement. And as Marisca says, that can be an administrative nightmare in order to make sure that SARS is not taxing you if someone else is. So again, this is literally what I do over here in Singapore with a lot of my clients, and help them understand kind of what they should or shouldn't do, and basically build the model for them to be able to make an informed decision. And with the help of Marisca, we are able to come to this kind of decision of whether or not it makes sense. But guys, we've received a lot of very good questions in the chat box, and I want to thank you for being involved and providing us with this. I just also wanted to run through our frequently asked questions, and from there I feel that there are a few of the questions in the chat that are going to be answered. Anything that is not answered, we will then come back to and answer for you. So let's start with perhaps the number one question I get asked all the time. If I cease my South African tax residency, do I lose my South African citizenship or my right to reside in the country permanently?
Yeah, the answer is no, because the Department of Home Affairs, they're not linked to the process at all. What you do when you give up your tax residency status is you work with SARS. They're not linked at all. You just give up tax residency, but you do remain a South African citizen and you retain your South African passport. So none of that is lost. You also still keep your ID. So everything is still the same with regards to your citizenship.
So you are a citizen, but you are a non-resident taxpayer. That is
correct, yes.
Now, the next thing is, Marisca touched on this earlier, is basically once you have ceased residence, what you have to do is you have to have a non-resident bank account. Previous to the phasing out of financial immigration, this was called a blocked account, excuse me. And basically, Marisca, if I am now a non-resident, I've gone through immigration, am I, for example, able, I mean, you said earlier we can't transact on this account, but am I able to run a debit order or a stock order off of the account?
Yes, you can. So they call it a stop order, and it would be for if you still own a property in South Africa and you have maybe levy to pay, or whatever you have to pay in South Africa, they can put the stops on the account for you, and it's as if it's a normal account. The only difference is you don't have the access to transact yourself. But this is why it's very important to work with an FX intermediary instead of with the traditional bank. And the problem with the traditional banks are that you, as a non-resident, it's sometimes very hard to deal with the banks because you work with call centers, and it's actually as bad sometimes where the person have to fly back to South Africa to come and transact on their bank account, and that's just it's not the way that you should be doing business. So working with an intermediary, they are your intermediary between yourself and the bank, and they would then you have a personal dealer, an FX dealer with them, and you can email them, you can say, hi, I need to make this payment, or please can you put the stop order on my account, or please can you send funds to me abroad. You have your personal relationship with them, and also if you need statements, you just email them and you ask them whatever you need from them. You do unfortunately not get this personalized service with a traditional bank. It's a little bit harder.
I'm not sure if anyone else on the call has tried calling Standard Bank from overseas or any one of our other banks. Look, they are quite helpful when you get them on the line, but it does take some time and it costs a fortune if you're calling from a mobile overseas. So I hear you on that, Marisca. So look, what if I receive an inheritance in the future after I've ceased residency? So I'm living overseas and one of my parents passed away, but I'm not a resident. What happens to that inheritance?
So this is also a big topic at the moment because it's viewed differently by different people in the space, and I just think it's because there's not a clear rules set out by the people who are involved, SARS and the funds and Reserve Bank. So the rules with SARS really is that if you inherit less than 10 million Rand, then the bank should be able to send it out for you without approval from SARS, and you don't need a tax number. If it's above 10 million Rand, then you apply from SARS for a letter of compliance. And again, you don't need an active tax number. But it's tricky, not all the banks will allow that. So what they do look at is if you never had an income tax number in South Africa, so maybe you were a minor or maybe you were a housewife and you never earned income, so never really had to register for tax, then that's quite easy, they allow that. But if you were ever registered for tax in South Africa, they're very strict at looking, how did you close your tax residency with SARS? So did you go through the proper processes of immigration, of ceasing to be tax resident and informing SARS and letting them know where you are? So you could sometimes find this process to be hard between the parties that are involved, but basically it should be no income tax number and you can send the funds abroad.
Very, very clear. I think the next thing is, what if I receive future distributions from, say, a family trust and I'm ceased to be resident? What happens to those proceeds and are they taxed?
Yes, so distributions from a trust could be taxed in the hands of the beneficiary, obviously, depending on the decisions that were made. So, for example, the trust owned a South African property and the trustees decided that that will be distributed to the individuals, then the whole process goes to the individual pays the tax on that. It needs to be declared on your income tax return and you'll pay the tax. So if you are a beneficiary of the trust, then you can't deregister your tax number because your distributions will have to be declared to SARS in the future.
Understood. And now bringing this to one of the questions that we received in regards to a family trust. If I am a member of a family trust and I'm a beneficiary thereof, when I cease to be resident, I'm not going to pay capital gains tax on the trust assets that I'm the beneficiary of, am I? Because those are owned by the trust.
Yes, so depending on what your interest in the trust is and what the trust assets are made up of. So it is something also just to get advice on to see exactly what the individual situation for that trust is.
Very good. So it comes down to the trust deed and how it was set up in the beginning. Very good.
Yes.
So the next thing is, what happens if I return to South Africa before 5 years have elapsed? And for everyone, the reason 5 years is important is this is one of the rules that has changed. So Marisca, can you tell us a little bit more about this?
Yeah, so this used to be called the failed immigration, and it used to scare a lot of people because, I mean, even if it's your intention now to leave forever, things do change. And in the past, what would happen if you had a failed immigration, you would have to apply, get special approval from the Reserve Bank. And if you had taken your retirement annuity fund out, there could be cases where you had to actually bring the money back and reinvest that. So that has phased out. So now if you return to South Africa, then you just need to inform SARS and you inform your bank about that. And then you could either reinstate your tax number if that was deregistered, you get the same tax number, it's just reactivated. Or if you were just a non-resident, you just inform SARS that you are a resident again. So it's quite a simple process.
So, and I mean, it sounds like a better process to what was in place prior, where if you have a failed immigration, there's some negative consequences, whereas now it seems a little bit more clean.
Yes, agree, definitely.
So the next thing is, must I sell my assets when I immigrate or cease residence?
No, you don't have to. So non-residents are allowed to have assets in South Africa. The only thing that they need to keep in mind is that they will be liable for tax in South Africa on the proceeds of these assets, because it's our tax basis that you pay tax on your South African source-based income. So this would be, for example, if you still have a property, you're going to pay tax on the rental income in South Africa. Or maybe if you have interest, you earn interest or you earn dividends, you'll pay tax on that in South Africa. Now, of course, we do have some exemptions on interest, and also the double tax agreement makes gives an allowance to reduce the dividend tax. So like we pay 20% dividend tax, but some of the double tax agreements will allow you to only pay 10%. So that's things to look at, but mostly your assets that remain will attract tax in South Africa.
I think that's quite clear, and we're getting quite a few more questions in here that are very specific to people's personal circumstances. So we're going to finish off with the last question, and we'll spend the last kind of 10 minutes of the call running through a few of these. If we don't get through all of them, we will reach out to you personally and try and answer the questions for you guys. Okay. So the last question here is, what if there is not a double tax agreement between where we live and South Africa? Obviously, that's not the case with Singapore, but let's say you've done your time in Singapore and you're now going off to Dubai or the UAE.
Yeah, so basically, if there's no double tax agreement between South Africa and that country, we go to the second test and the third test of testing your residency in South Africa. And the one is your ordinarily residence test, and then also your physical presence test. And things that are taken into account when we look at that is, like, what was your intention when you left the country? You have to show quite strong intention to SARS that it was your intention to leave, to cut all your ties. So did you sell all your assets and have your family immigrated with you? You can't say that it was your intention to leave, or you're not an ordinarily resident when your wife and kids still live here and your house is still here. So you need to show, has your family immigrated with you? And then have you cut your remaining ties? Like, are your businesses still here? Is all your investments still here? And you just maybe living in Panama because you enjoy the lifestyle, then you didn't cut all your ties. So that's important to look at. And also, what are your intentions in the new country? So did you move there, maybe bought a house, making up investments there, you setting up businesses or have employment there? So that's very important. And then also just your center of vital interest. And that's basically, where's your gym and where do you have contracts and those kind of things that you look at. So just to explain what the ordinarily residence test is, it's not defined in the Income Tax Act, but it's been described as your place where you will return to after your wandering. So if you are in the rest of the world for the next 20 years, but you do love South Africa and you think that you want to come retire here, you've maybe kept your holiday home and maybe you do keep your pension because you are coming back here, then you're an ordinarily resident of South Africa. But if you have no intention of doing that, then you're not an ordinarily resident. And then in that case, you can again give up your tax residency because you've cut all your ties and you're also not planning to come back here. So the next one, the physical presence test, this is really how to become a tax resident of South Africa if you're not by naturally a tax resident, is that we look at it over a 6-year period, and then in the 6th year we look at the 5 preceding years. So you have to make at least the minimum requirement is that you have to be in South Africa for 91 days for that year, and then for every 5 year, and then over the 5-year period you have to be here for a total of 915 days. So to give an example, like in year 1 you're going to be here for 91 days, so you meet that requirement. In year 2 you can be here for 200 days, in year 3 you could be here for 300 days. So there's not a specific amount that you have to be here, but minimum 91 days. At least in total it's got to be 915 days. So why I bring this up of becoming a tax resident is because when you emigrate, I always like to flip this around. So you have to then be careful if you are planning on maybe, coming to spend some time in South Africa, maybe you want to have our summers and have the summers in another place, then you have to be careful of not meeting the physical presence test again. So over the next 5 years, just keep track of your days that you spend in South Africa. And if you have spent and met the requirements in year 4, then in year 5, you just have to go, okay, next year I can only come to South Africa for less than 91 days. So then you break that again and the next 5 years start. So very important to keep track of your physical presence in South Africa after you've emigrated.
This is extremely important in the times we live in, where people were locked out of Singapore for a period of time. They were unable to return. Guys, COVID seems to be here for a little bit longer still, so this could become a factor. So just be aware of, the days test. It's simply called the days test. But Marisca and I were joking earlier when we were preparing for this, and we were saying, we find tax a little bit exciting sometimes, and we're a bit of tax nerds. And for anyone who is actually particularly interested in the idea of ordinarily residence and the phrase where you will return to after your wanderings, look up the case law. You can just search the case law for return from after your wanderings and read through the case. It's it's an old case. I think it was in the 40s, and it's just really funny to read through it and see that is still relevant to this day, and that 9/10 of the law is intention. So being able to prove what your intention is, whether you're returning or not, is extremely important. So everyone, that's kind of the end of the frequently asked questions, and we did cover off some of the questions here. But Marisca, I'm going to pick 3 of the questions that are in this box and ask them. Okay. So we mentioned the certificate of residence earlier from Singapore. Do SARS want a digital copy, or must we post you the physical copy?
Digital copy is perfect. We don't need anything original.
Easy. So now, a question that came up twice here is, I've ceased tax residency and I meet the requirements for a number of years. I'm outside of South Africa, and then I return to South Africa. And does that mean that I have this gap where I've been non-resident, I haven't been taxed on my foreign employment income, but now I've returned to South Africa and I've become tax resident again? Am I then taxed on the period I was non-resident?
No, you're not, because you're meeting the tax treaty is almost like an annual thing. So for the time period of being out of South Africa, you did meet the requirements. So therefore you were not a tax resident. You did not have to pay capital gains tax. Income tax on that. So when you return, it's a clean slate again. You start from there.
I think that's going to put at least 2 people in the call a little bit at ease if they were to return. So the next question is, now, in terms of a tiebreaker clause with a double tax agreement, and I have a house in South Africa, but I don't sell it, I don't rent it out, and it's just for use for extended family, is this going to be a negative factor in terms of a tiebreaker test?
It could be, and I'm actually very happy that you brought up this question, because this is very important, is that You are a tax resident where you have a permanent home. Now, a permanent home does not mean that you have to own the home. It just means that's where you live, that's where you reside permanently. Now, if you have a permanent home or a home in South Africa and it's not rented out, or it's not on the market to be sold, or it's not permanently listed on like Airbnb or a site like that, then that means you have a permanent home in South Africa, because you can get on a plane, fly to South Africa, and you can go to your house in South Africa and live there at any time. So that means you do have a permanent home available in South Africa. But that shouldn't be the only factor. That's only the one tiebreaker. So then if you have the permanent home in both of them, then we go to the next one and see where's your center of vital interest. And then we also look at your habitual abode. And your habitual abode is basically where have you rested and recouped the most over the last 5 years. And if you've done that in both countries, we also look at nationality. And if you still can't determine that, then the two countries decide. But hardly we ever go to that, because you can very easily prove your center of vital interest are in Singapore if that's where you live and you've got your permanent home. You just got that property in South Africa. So it shouldn't be too negative, but do just know that what a permanent home means.
Absolutely. And in terms of vital interest, that includes where is your family interest, so your closest family, be it your spouse and children. It includes where are your financial interests, so where do you draw an income from and where are the majority of your assets. These are just some of the things when we say vital interests, this is what we're talking about. So we got a question here again, another one about the bank accounts, and this is quite a popular topic as well, as per our last webinar last week as well. So essentially, if I have ceased residency via financial immigration, is it a requirement that I have a non-resident bank account?
Yes, it is a requirement, and it's up until this moment, I kind of feel like the banks trust you to do the right thing to tell them about it. It's not like SARS and they speak to each other where they're going to get a notification from SARS saying that you've done this. So the rule is that you need to inform your bank about it. The only thing where I've really picked up that the banks act upon this is they would ask you to prove. They do this whole FICA document. They would say, please prove to us where you are a tax resident. And this would be if they kind of pick up you doing foreign transactions. And if you don't answer them, then they can actually freeze your bank account until you do answer them. So it is your obligation to inform the bank that you're a non-resident, and then close your normal accounts and just have a non-resident account.
Okay, very good. Someone actually just gave a little piece of very good advice here. They've just said, in regards to your bank accounts, it's very important to appoint a power of attorney on your South African bank account, someone you can trust, who can assist with the signature for you in South Africa to help speed this process up. I think that's correct. Prudent planning.
Yeah.
That's very good. Thank you, Kuben.
Yeah, that's very important. And this was the fact where I mentioned that sometimes people have to fly back to South Africa to close their bank account because they're not able to do this over the phone or electronically if they don't have that power of attorney. So that's important.
There's so many very good questions. Marisca, we're about 3 minutes away from the hour. Are you okay to spend just 10 more minutes to answer maybe 3 more questions?
Yes, I'm very happy to do that.
Okay, so everyone, if you have other obligations and you're going to drop off, this is being recorded. It will be put on our YouTube channel, and you'll be able to hear the rest of the questions. But if you have a few more minutes, just stay with us. So another question that's come through here, it says, if I'm registered as a non-tax resident and I've completed the capital gains tax declarations, do I still need to submit a tax return to SARS every year with my South African sourced income, as well as declaring my worldwide income? So they're a non-resident, they've been through the whole process. Are they obligated or required?
Yes, so if you earn South African income, then you are obligated to submit that tax return, but you only need to declare your South African source-based income. And because you're now a non-resident, the Income Tax Act says that you don't have to declare your foreign income to SARS. So you leave that out of your return. It's none of SARS's business what you earn elsewhere in the world. It's really just what you earn here in South Africa.
Brilliant. Something that is interesting, and it has come up to me as a question before. Some of my clients have dual nationalities. Sometimes they're British South African, or I have a client who's Lithuanian South African. And so the question is, I've purchased a property and I have dual citizenship, but I purchased it as a foreigner, not as a South African. So I used my foreign passport. How would this complicate matters if I was to immigrate from South Africa via the ceasing residence process we've just gone through?
So the property won't have an effect on immigrating from South Africa because that's excluded from your capital gains tax when they immigrate. So that will only be taxed in the future. They'll pay the same tax as if they were supported as a resident or a non-resident. The reason why there is a difference between buying as a resident and a foreigner is that when you sell the property, the buyer of the property or the conveyancer need to withhold capital gains tax on the sale of that asset, and that's 7.5% of the selling price of the property. So that's only really where the difference between buying and selling as a foreigner or as a local South African comes in. But as far as immigrating, he won't be affected on the property.
I think that's quite clear. I'm just seeing if there's any other questions here that aren't too personal. Okay, so everyone, there's only 2 questions left that I feel are very particular to a specific person's circumstances. So it's obviously best if they would seek individual tax advice on that. Is there any other questions to the group at large that anyone would like to have Marisca answer for us today? We're getting some thank yous. You're most welcome. Very welcome. All right, so everyone, if there are no other questions, or if you are still typing, that's okay. We'll just go to our last page here. So the South African Chamber of Commerce in Singapore, we're a growing organization, and we have been here for the past 3 years. And basically, we focus on stimulating trade and industry between South Africa and Singapore. We host lots of informative events like this, and some of them are fun. Sometimes we also do drinks, we also do networking lunches, we do all kinds of fun stuff. So please do follow us on social media. You'll find us on Facebook and LinkedIn and on YouTube, South African Chamber of Commerce Singapore. And our website is simply www.sham.sg. So please do give us a follow and check out our future events. And Marisca, for people to reach you, the best way for them to get in touch with you, would you say, is this email address?
Correct, yes.
All right. And you can also find Marisca on LinkedIn, and you can look her up and connect. She does share some of her insights on there as well. And as for myself, I post a lot of interesting insights applicable to South Africans living in Singapore from a financial planning perspective, be that estate planning, succession planning, investment management, all those areas. So please do connect with me on LinkedIn, or feel free to drop me an email to discuss further. We just got one more question. Let's have a look here. Okay, so this person has not ceased their residence. They have never earned quite a lot of money in terms of the taxation tables. And they've said, now I'm overseas and I still earn less than R1 million a year. Am I going to be in trouble? And should I be, what is the implication on this?
Okay, so obviously they will be tax-free if they meet the requirements of Section 10, the 183 days of being in an employment contract. So they won't be taxed in South Africa. However, they still are obligated to inform SARS of their ceasing to be tax resident because of the tax administration requiring that of them.
Okay, brilliant. I think that answers. And everyone, thanks very much for your time this evening, and we look forward to engaging with you further in future events. Please do expect an email from myself and perhaps a phone call if you are based in Singapore. We'll be sending out this guide to you via email after the fact, and if there's any further questions, feel free to contact us. Thanks so much for joining us.
Thank you. Bye.
Bye, Marisca. Thank you so much.